This presentation compares major global mining ETFs across key commodity themes including gold, silver, copper, uranium, and diversified mining. The goal is to help investors understand how these ETFs differ in strategy, asset size, fees, portfolio concentration, and holdings. Mining ETFs are not interchangeable. Some provide broad exposure to large-cap miners, while others are highly specialized, such as uranium or junior miners. This presentation highlights those differences, so investors can better match an ETF with their own commodity outlook, risk tolerance, and desired level of diversification. This slide explains the scope and data methodology. The comparison is designed to provide a broad market view of major mining ETFs, while helping investors evaluate which vehicles best fit exposure to sectors like gold, silver, copper, uranium, or diversified metals. The data was compiled directly from official provider pages and updated mainly between March 9th and March 10th, 2026. That is important because ETF metrics such as assets under management, holdings, and weights can change over time. The purpose here is not just to list funds, but to compare them using a consistent framework. This slide covers GDX, the largest and most established gold miner ETF in the group. It focuses on large-cap gold mining companies and has approximately $32.37 billion in net assets, making it the most liquid and institutionally relevant gold miner ETF in the comparison. The expense ratio is 0.51%, and the portfolio contains 53 holdings. The top three positions are Agnico Eagle Mines at 9.9%, Newmont at 8.7%, and Barrick Mining at 6.4%. The main takeaway is that GDX offers broad but still somewhat concentrated exposure to senior global gold miners, making it a core vehicle for large-cap gold equity exposure. This slide focuses on GDXJ, which targets smaller-cap junior gold and silver miners. It has approximately $10.6 billion in net assets and an expense ratio of 0.51%, matching GDX on fees but with a very different risk profile. The fund holds 95 companies, offering broader diversification across smaller miners. Its top three holdings are Alamos Gold, Pan American Silver, and Kerr Mining. The key point is that GDXJ gives investors more torque to rising precious metals prices, but also higher operational and market risk, because juniors are generally more volatile than large producers. This slide covers Ring, another global gold miner ETF. It has approximately $3.67 billion in net assets and a lower expense ratio of 0.39%, which is more cost-efficient than GDX and GDXJ. The fund holds 42 major global gold mining companies, and the core holdings include Newmont, Agnico Eagle Mines, and Barrick Mining. The main distinction here is that Ring offers large-cap gold miner exposure similar to GDX, but with a smaller asset base and lower fee. For investors comparing the two, the trade-off is often scale and liquidity versus cost efficiency. This slide introduces URA, which focuses on uranium mining and the broader nuclear fuel cycle. It has about $6.89 billion in net assets, an expense ratio of 0.69%, and 54 holdings. The top holdings by weight are Cameco at 24.3%, NextGen Energy at 7.0%, and Oklo at 6.9%. This shows that URA is relatively concentrated, especially around Cameco. The key idea is that URA provides broad exposure to the uranium and nuclear value chain, not just pure uranium miners. That makes it useful for investors who want a wider nuclear-themed ETF rather than a narrower pure-play uranium vehicle. This slide covers URNM, which is much more focused on pure uranium miners and uranium-related vehicles. It has approximately $2.29 billion in net assets, an expense ratio of 0.75%, and only 26 holdings, making it much more concentrated than URA. The top holdings are Cameco at 21.5%, Sprott Physical Uranium Trust at 11.6%, and Uranium Energy at 11.2%. The key takeaway is that URNM is the more concentrated and more uranium-pure ETF. Investors generally choose it when they want stronger direct sensitivity to the uranium cycle rather than broader nuclear industry exposure. This slide looks at SLVP, a silver and other metals mining ETF. It has approximately $1.24 billion in net asset value, an expense ratio of 0.39%, and holdings in 30 companies. The fund focuses primarily on mining and production companies tied to silver and related metals. The relatively small number of holdings means sector exposure is somewhat concentrated. The slide also notes that major holdings include large silver producers, such as Hecla Mining. The key point is that SLVP is a targeted silver miner ETF, but with enough exposure to related metals to make it somewhat broader than a strict pure silver vehicle. This slide covers COPX, the Global Copper Miner ETF. It focuses on copper exploration, mining, and production worldwide. The slide highlights a multi-billion-dollar asset base, a competitive expense ratio of 0.65%, and 40 holdings, which creates a reasonably diversified copper mining basket. The top holdings shown are London Mining at 6.0%, Sumitomo Metal Mining at 5.9%, and Boliden at 5.5%. The main takeaway is that COPX offers direct copper cycle exposure while avoiding extreme single-name concentration. It is a useful vehicle for investors bullish on electrification, grid infrastructure, and long-term copper demand. This slide introduces PIC, the broad global multi-metals and mining ETF. It has approximately $1.94 billion in net assets, a low expense ratio of 0.39%, and a very diversified portfolio of 235 companies. Major holdings include BHP, Rio Tinto, and Freeport-McMoRan. The significance of PIC is diversification. Rather than betting on one metal, investors gain exposure across a broad set of mining companies and commodities. This can reduce single commodity risk, but it also lowers direct sensitivity to any one metal bull market. PIC is more of a broad mining sector allocation tool than a thematic commodity bet. This slide covers XME, the U.S. Metals and Mining ETF. It focuses on U.S.-listed metals and mining companies rather than global miners. It has approximately $4.31 billion in net assets, a very competitive expense ratio of 0.35%, and 35 holdings. The top holdings shown are Kerr Mining at 5.6%, Alcoa at 5.4%, and Freeport-McMoRan at 5.3%. The main distinction here is geographic and listing focus. XME is useful for investors who want metals and mining exposure specifically through U.S.-listed equities, which changes both sector composition and risk profile compared with more globally diversified funds. This slide summarizes the key findings from the ETF comparison. First, mining ETFs have very different investment focuses, ranging from broad diversified exposure to narrow commodity specialization. Second, there are major variations in key metrics such as expense ratios, assets under management, and number of holdings. Third, each ETF reflects a different thematic emphasis, whether that is large-cap gold miners, junior precious metals companies, uranium, copper, or diversified mining. Finally, gold and uranium-themed ETFs tend to show higher top holding concentration than broader diversified funds. This slide is essentially the bridge between fund-by-fund comparison and practical investor takeaways. This slide turns the comparison into a decision framework. There are 4 key considerations when choosing a mining ETF. First is investment focus. Decide whether you want exposure to gold, silver, copper, uranium, or broader mining diversification. Second is expense ratio, because fees directly affect long-term returns. Third is net assets and liquidity, which matter for fund stability, tradability, and institutional relevance. Fourth is holdings and concentration, since concentrated ETFs provide more thematic purity, but also more single-stock risk. This slide is useful because it moves the discussion from description to application. This Q&A slide invites discussion around ETF strategy, market developments, and commodity-specific opportunities. It highlights the major themes investors may want to explore further: how to compare sectors, how macroeconomic conditions affect mining ETFs, and how to think about diversification, risk management, and future trends. In a live setting, this is the point where the audience can ask whether they prefer broad mining exposure, a more focused gold or uranium strategy, or a thematic allocation tied to a particular metal cycle. It also opens the door to discussing how liquidity, fees, and top holdings affect ETF choice. This final slide wraps up the comparison. The main conclusion is that mining ETFs offer a wide range of choices, from highly specialized metal exposure to broad diversified mining strategies. Investors should focus on 4 core metrics when selecting a fund: expense ratio, net asset value, holdings, and concentration. The second key conclusion is that each ETF has its own market positioning. Some are built for liquidity and scale, others for concentrated commodity exposure, and others for broad diversification. So the best mining ETF depends less on which one is best overall and more on what kind of commodity exposure the investor actually wants.